Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say can be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Friday, March 8th, 2024, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and this week I went out on an adventure and I went fishing again for earnings. Fishing for earnings, I had 3 earnings trades that I put on, and I want to recap them because one was great, one was not so great, and one was really bad. And those were in Foot Locker, Nordstrom's, and MongoDB. Before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there. You can talk to myself, some of the other Blockhead traders. We'd love to hear what you're trading, and we'd love to hear what type of content you want to hear about. You can also go to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. And last, this is available in an audio-only format wherever you get your podcasts. And if you can't find it there, let us know and we will get it there. All right, so earnings. As you know, earnings are one of the favorite types of premium selling plays that I like to do. They can be incredibly exhilarating, and they can also be kind of painful. And this week, I got a little bit of both, exhilaration and some pain. And I want to talk through all 3 of these here with you guys today. I'll start with the worst situation. I'll move to the better situation. And then I'll close out with the really, really good situation that I just had for the third one. So I want to kind of touch on that because the first 2, they're still in motion because they busted out of my strikes and they're basically in a management mode. And I just want to kind of talk you through some of the stuff that goes through my head when we're going into the management of these and some of the psychology that you'll feel as if and when you get one of these earnings trades that kind of goes against you. Now, the first one I'm going to cover is Foot Locker. Foot Locker is a retailer. All 3 of these trades were really overextended in the volatility front. The first 2 were at 100% volatility over the past year. And then the third one was in the high 80s percentile of IV, implied volatility. But the first one here is Foot Locker. And I want to bring up some of the numbers of Foot Locker first, and then we'll switch over to the Flappy Bird chart when I kind of talk about, where this looks like graphically. So Foot Locker got absolutely whacked when it came out with its earnings. It really got whacked after hours. It started to kind of hold a floor, which was right at my strike price. And I thought, oh my gosh, this is going to be awesome. It's going to be another winner. We're going to hold at this level and reject up and kind of go higher when the market opens. Not so. So pre-market, I think it was down 10, 12%, something like that right out of the gate from earnings. No, it must have been higher than that. It must have been in the 15 to 18%. Anyway, market opened and then whack again, got knocked down more. And so this one, I originally started at a 29 put. So the earnings, it was originally trading in the low 20s, maybe 21, somewhere around there. And so I put out the 29 put, and I went with a 20 delta put, which is a little more aggressive than I go on the earnings. But I kind of like to creep up that aggressiveness the higher the IV percentile is. And so while I normally start at a 16 delta, because this was in a 100% IV rank, I thought, you know what, let's pull that into a 20 delta and collect a little bit more premium on the move. And so I went with a 29 put and a 44 call, which was a very wide range, given that it was trading, in the low 20 there, 21, 50, somewhere around that vicinity. Well, earnings came out and the market was not happy with the earnings. In fact, I think it was down 30% at some point the day following the earnings. But going into it, I did 8 contracts at $1.30 a piece. So I collected about $1,040 there on my first thing that I sold on March 5th. Now, the earnings came out after the bell or before the bell, I can't remember what, but basically on the 7th or the 6th, sorry, the next day, that's when we just got whacked down. And my play is to basically hang on to those, look for a return to reversion to the mean. And if I don't get it by the end of the week, because all of these expire at the end of the week of earnings, so they were going to expire on Friday today. And if I don't get that, then I'm going to go ahead and roll that and basically collect some more premium on the roll and go from there. Well, this thing, I mean, it was trading down at around, I don't know, $17 or something here on Friday. And so I rolled this out. Now, I let the call expire worthless because there was no way we were making it back up there to $44. So I went and I rolled the 29 put. Now, normally I roll out to the next monthly expiration, which in this case happens to be next week. So not a huge roll forward. I would have gotten some more premium if I went further out in time. Now, the reason I didn't do this is because there was actually two reasons. One, that much time premium really doesn't help you when you're that deep in the money. So even though there's more time, because it's so deep into the money, the extrinsic value there's really just not much there. And so what I'd rather do is roll for a shorter length of time, hoping that we get some of the price appreciation back. And then if we're still not there, roll again. And now the premium might be a little bit more if we start trending in the direction that's favorable to me. The other reason that I didn't go out that far was because I was already going to take a hit on the strike that I rolled to. So sometimes when you get into these weekly expirations, the strike that you set isn't available for the roll because the weeklies will have more strikes on them than the monthlies and things like that. And so rolling out to a monthly, or in this case, next week or even April, there was no such thing as a 29 strike, which means I have to move to, a lot of times they're divided up by $5 strikes. So I would have to move to either a $30 strike or a $25 strike. And because I'm already buying back the intrinsic value in this, because I'm already deep in the money, if I was to roll down the put to like a 25 strike, I would basically be forfeiting that intrinsic value that I had to buy back at the 29. So what I mean by that is, if it's trading at, let's say 20, okay, and I have to buy back the 29 put, that has $9 of intrinsic value. That's never going to decay, right? That's built into that price because it's at a 29 strike, but it's trading at a 20. So you take the difference and that's your intrinsic value. If I had moved to a 25 strike, I would pay $29 to get that, and then I'd collect back $25. So I would be out $400 right out of the gate. And I just couldn't make that back in the premium. So what I opted to do instead was move the put up because that basically is selling more intrinsic value. So I bought back the $29 put for roughly $29, and then I sold it for the $30 plus extrinsic value. Now, because it's only 1 week out and it was so deep in the money, there was almost no extrinsic value. So I'm really just trading the intrinsic value here. So that's what you see there on the roll on today of March 8th is I collected $1. And that dollar was really just that intrinsic value that I moved when I moved the strike up to a 30 put. So right now I have collected $1,840 on this trade. However, my buying power has dramatically expanded because I'm deep in the money on the put side. So while I opened this trade with buying power of 5,500 or 5,400, that has expanded now to $8,700. And so I've shifted my return on capital because now I am consuming more capital to hold this trade. So it's still a decent return on capital. Remember, this is next week. So if I get return here and we get some bounce back, then I'm going to get a return on capital upwards of 21%. Now, that's probably not realistic. We'll probably end up rolling again. And so the buying power will likely stay the same. It could increase more, but not a ton more unless it really starts to dump. So that's where I'm standing. That 21% is that 1840 divided by 8,700. So let's hop over here to the Flappy Bird chart just to see how ugly this is. This is the ugliest earnings trade that I've got going on because they just got walloped. And I'm sorry, I was totally off when I was saying what they were trading at. I was actually looking at Nordstrom on my other screen instead of this one, Foot Locker. So when I opened this trade, we were kind of mid 30s, about 34. And now we're trading down in the maybe 24 range. So you can see right here on this Flappy Bird, this is when I opened the trade. Right here is the earnings announcement, and they just got hammered. We blew through the strike. So it did hold up briefly here on these two candles. This gap between these two candles, that's where it kind of was pre-market. And then the market opened and it just took another jump down, almost as much as it had already fallen, if not more, in the pre-market. And we're really settling out here on the 24 level. Now, looking back, I won't go through the charting of this, but 24 is another important level where we could come back to test, looking for either a rejection off of this. If this fails, we're probably going a lot lower, but I'm holding out that this is they're gonna roll back. The second box, now you notice how the second box is higher. That's that rolling up $1. So pushing that put up, you can see just how deep in the money I am. And then I took the trade of more intrinsic value. And so again, I'm deeper in the hole. Very, very red. This one does not feel very comfortable right now. However, I have been in this situation before in many, many stocks. Roughly 16% of my trades will land in this type of position. And I'll just keep rolling for as long as I can. If I get assigned, I will flip the narrative and I will start selling covered calls against it. I'll collect dividends if the stock pays dividends, and I'll just keep battling back from that. Foot Locker doesn't actually pay dividends, so nothing there. All right, so this week was a lot of retailers, and the next one that I looked at was Nordstrom. So both of these were put on at the same time as the Foot Locker and Nordstrom. I think one was after the bell one day, and the other one was before the bell the next day. So right here is the Nordstrom call. This is the one that when I put it on, it was probably in the low 20s, 20 to 21. I misspoke earlier. So this one, I went with another 20 delta because this implied volatility was also at almost 100%. I think it was 99%. And so I opened up a strangle at around the 20 delta, which put me at an 1850 call and a 1850 put and a 24 call. And it doesn't seem like much, I guess, from where it was, but it was still a decent size move for, something trading around $20. And so this one, I actually did 10 of these contracts. I sold the strangle for 65 cents a piece at 10, so collected $650. And I had to, this one busted through after earnings, actually held up above the strike for a little bit. And then when the market opened, it went down. Now, similar to Foot Locker, this was an 1850 strike. And so when it came time to roll today, I rolled it today on the 8th. There was no 1850 strike to roll to. So I went out just 1 week because I go to the next monthly expiration, which is March 15th. And again, I have to pick another strike. So I'm either going down into the 15 strike or I'm going to go up to the 20 strike because they were separated by $5 strikes. And so in this case, I actually went up to the $20 strike because, again, I was kind of trading below. I was already deep in the money, and I don't want to buy that intrinsic value only to sell less intrinsic value. I need that intrinsic value to either be a wash, which is the ideal, or you make more intrinsic value on the sale. I couldn't do the wash, which is what I normally would have done because, again, that 1850 strike was not available. So I moved up $1.50. Now, again, notice that, oh my gosh, what did you collect? $1.50. So just like Foot Locker, don't think I'm getting a lot of extra premium here. This is simply because I bought more intrinsic value. Sorry, I sold more intrinsic value, which just means I have to go that much further to get out of the hole. So in this case, the first one I collected $650. The second roll here that I did today, or the first roll, the second trade, I collected $1.50 for all 10 of those. So again, that's another $1,500. That brings my total collected on this one to $2,150. Now again, this buying power also expanded. I think it was originally around 4,200 when I opened the trade. Now that we busted through the put side, I let the call expire worthless. I did not buy it back. I let it expire worthless because it was way, way, way up there. It was not getting hit. And so the buying power expanded about 6,800. So if you divide out my 2,150 by 6,800, you're looking at a potential of a 32% return on capital. Now, this one is not as deep in the money as Foot Locker. And so that's why I say this is the bad one, but not the terrible and ugly one. So we're getting a little bit better. And if I flip over to the Flappy Bird chart to graphically see this, just like Foot Locker, my first two red boxes, that is where I was pre-earnings trade. This first red candle is the after hours earnings. Then we held here, and I thought we were going to be in pretty good shape. And then on open, we dumped a little bit, kind of hung out there. We dumped a little bit more. We're starting to kind of consolidate down here around the $17 mark. So again, this second red box, raises up here because I have sold more in intrinsic value. I moved my strike up to $20. And so this other end of the box is March 15th. That's when these expire. I will hang on to these, hope my strikes get through this before then. If not, I will look to now roll out to the next monthly. So once I'm in this roll mode, I'm going to stick to the monthlies. And so, earnings was a weekly. When that fails, if I roll to the monthly. When I'm on the monthly, if I need to roll again, I'm going to roll to the next monthly. Now, I should be on strikes that should always be available, so I shouldn't have to shift my strikes anymore. And so I'll be able to keep those awash as we move on through those. Now, I told you I did have a good one. I did have an exhilarating performance here that was a lot of fun. And let's talk about that one real briefly. This was not managed. I did not need to manage this. This was MongoDB, some kind of tech database company. Not sure I know much about it, but basically their earnings were today before the bell yesterday after the bell on the 7th. I put this trade on the 6th. I misread when the earnings actually were. I thought they were after the bell on the 6th, but they were actually after the bell on the 7th. And so I put the trade on a day early, but that's okay. It worked out just fine. Now, this one was not at that 100% mark. It was only at around an 87 or 88% implied volatility stretch, which is super high. Don't get me wrong. But it was more in what I like to see. And so I did not get aggressive on these strikes, and I stuck with the 16 delta strikes. So this was also a very large stock from an underlying price, and I'm not really comfortable playing those in real tight because they are really big. And so you can see my put was at 357.50 and my call was at 500. Now I only did one of these contracts because this was very, very large. And so I collected $12.10 or $1,210. This thing, I'll show you the Flappy Bird chart, but we stuck in the range very, very well. It was going to expire absolutely worthless today. I did not close it. I let it run out for 100% of my premium. It expired worthless. And you can see overnight, I put the trade on early, so 2 nights. Out of a buying power of 6,500, I was able to collect 1,210. That is a 19% return on capital. And if we switch over to the Flappy Bird chart, you can see exactly what I'm talking about. So this is MongoDB going into earnings, which is the green flag down here, which is where the big red candle is. We hit earnings, we dumped. It actually very briefly went below my strike, then rapidly recovered, and then kind of rallied and fell off. Right here where these boxes end is where the stock ended for the day. Right in between my strikes, which means my options that I sold were absolutely worthless, which means I collect every single penny that I had collected, I get to keep. And so that was a very nice consolation prize for the 2 busted earnings that happened earlier in the week. And that brings us to the end of this week's episode where I had 3 earnings trades. The important part that I want to kind of call out here is just the trading psychology and mentality. And I'm pretty calm about all of this. I'm not super upset or anything. Is it a bummer? Yeah, it's a bummer. But, I know my game plan from here. I know that I'm going to hold them. I know that I'm going to roll them, and I'm going to keep collecting premium on them. And if I get a sign, that's okay. that is the plan, is to go ahead and take assignment if they get busted and if your rolls keep going. And then you'll turn around and sell calls, collect dividends if they have it. This is the trade going in. Now, is that the ideal? No, the ideal is what happened with MongoDB, where you stick it right in between your strikes, they expire worthless, and you keep every penny. That's the perfect scenario. But when I talk people and tell them, trading options without protection, things like that, you have to be okay with assignment. And so going into all of these earnings trades, that is one of the questions that I ask myself is, if I get assigned these stocks, is that okay? Is it okay if I hold 1,000 shares of Nordstrom? Is it okay if I hold 800 shares of Foot Locker? And these are things that factor into my decision. Is it ideal? Do I want it? Not necessarily, but am I okay with it? And can I manage it? And will I still come ahead green in the end? Yes, I believe so. And that really helps you in these type of trades. Early on in my trading career, when I would put these trades on, I thought, oh, it's always going to come up roses for you. And I really had no intention of holding the shares. I really didn't want them. And so when they go against you, you really get a sense of panic and worry about it. And it's just not a comfortable feeling. And that's when I started learning that you really need to prepare for the worst case thing that can happen and be okay with it. Now, if you don't want to take assignment, right? Maybe your worst case is booking the loss. Maybe you have a bailout price, and I do have a bailout price a lot of times when I do other regular earnings or regular premium selling trades. But when it comes to earnings, it's so fast and so quick that a lot of times you don't get to react to something like that, and you could be really deep in the money, and you could get an assignment and have no ability to avoid it because of how quick they move after hours, where you cannot trade options. Options do not trade after hours. And that's why it's very, very important going into earnings to understand that risk of assignment and be okay with it. So hopefully you guys had a good trading week and you got something good lined up next week. We'd love to hear what type of content you're out there trading, and always like to see different styles and things in the Discord. Love to hear from you. Good luck out there. And remember, think outside the block.